Those of you who don't know me, my name's Jeremy Conybeare. I joined FAL 11 years ago. That was off the back of Phil opening the company, starting the company in 2007. We are, for those that don't know us, we are sort of Southeast Queensland's largest boutique agency. We have under property management about $1.2 billion worth of property that really stretches the entire coast of Queensland now, and some of the bush as well. Our main footprint is in Brisbane here, secondary footprint Gold Coast, and when we kind of get a bit thinner beyond that. Just from an agency point of view, we do we have a great sales and leasing team. There's about 7 of us, and we are patch driven, so we here to understand our markets intimately. I happen to be running the West, which I've been really enjoyed doing in the last 11 years, and yeah, it just helps create community connections. One of those which here at West Rugby Club, we are really proud sponsors also of Wests, and it's great to be here today with you. So I just wanted to also mention, Phil started, Phil's the director of FAL. He started the company in 2007, I think out of balcony of your house from memory. Yeah.
That's right.
So there we go. So it was Phil and a phone, and he's a determined fella. He now leads a team of 30. He's built a really great business over the years. So good job, mate. So we'll just jump straight into it. I just want to touch on a couple of major driving growth and a good story for Brisbane. The first of which is net migration. So Queensland easily has the most positive net migration of any major city in Australia. We've increased about 2.5 points a year on year for the last 5 years. The ABS, being the ABS, didn't print last year's figures, but I understand that the 2024 to 2025, that is quite consistently another 2.5% on top of it. And that, interestingly, is coming from not just a national growth perspective, but also international. So international migrants for now is stuff that you would need to have formally flown to Sydney or Melbourne for, but we now have here in Brisbane. So the other major sort of disruption, if you like, to the market in the last 5 years has been the emergence of buyers agents. It's a bit of an American model, but there's been a couple of major players in the buyer agency world that have bought investors from traditionally retail investment profiles and pushed them into commercial profiles. Investors, of course, are just seeking high yields all the time, and buyers agents have sort of jumped on the sort of the low return model of low cash return model of residential and sort of pushed them into commercial. So we're seeing the lower end of the spectrum, the sub $2 million category, really busy now, and that has really condensed yields across the country, but particularly here in Brisbane. I mean, when I first started at FAL 11 years ago, it wasn't uncommon for retail assets to trade at sort of 7% on a yield base, and that now is it's 6 into the 5s, and really good stuff, you're into the 4s now in terms of yields. So we've seen a real compression of yields, and they are, in our mind, the 2 major driving factors: supply and demand, and the fact that there's just a lot more buyers in the marketplace with an increasing population. I did want to touch on construction costs very briefly. Sam here addressing this in a much more detailed way than I will, but I did want to say that existing stock versus greenfield stock, just a quick comment there, that labour costs are high because labour is in high demand at the moment with the preparation of the Summer Olympics coming up. Major infrastructure projects occurring, and as a result of that, we've got really high costs in build, which means that if you own stock or want to buy stock, it's about existing stock. So finding the right economic model to give you new stock on market now and to be able to retrieve those rents to make it stack up is really thin on the ground. So we've been really concentrating on repositioning properties at FAL with the help of Sam and others to drive higher face rents as opposed to looking at greenfield sites where we're building fresh. In saying that, the greenfield sites and the redevelopment sites that are occurring tend to be in the residential side of things at the moment. You can see Mosaic here on Coronation Drive. You've got also Greyer, a couple of other boutique companies really doing a good job in that space for luxury sort of apartment living. Residential development always happens first, and commercial has really lagged behind that. Commercial will end up filling the gap that the residential demand will will lead to a certain demand, and then commercial will catch up to that demand and fill in the blanks after that. So we will see, more growth in the space. So just a quick thing about office. So the office market in the past 5 years has been a really interesting story. Pre-COVID, it was a really good bet for investors. Investors were, if you had a good covenant tenant, a good, company or a law firm or an accounting firm that had been in an office for a long time, people, investors were buying stock, in, as you can see here, in about the mid 6%, and then for premium grade, and then sort of the higher sixes to nearly 7% for the sub premium market. But what happened was that obviously COVID introduced a bunch of government subsidies. It allowed work from home to occur, and of course vacancy just shot through the roof across Australia and the world. But it really affected Brisbane, and it really affected investor confidence. So as you can see, in the last 5 years, investor confidence has really waned in the office market. And if you own office at the moment and you've got tenants, it's still a real coin toss, whether to offload that property as a lease investment versus allowing that lease to run through and move that out as a vacant possession asset. We're finding vacant possession sales in the office market really strong at the moment. That's been a good story in office, but you're in an office environment, or you hold an office building with rents and tenants, then our general advice is hold for the time being and just wait for those leases to run down, and we can reevaluate that down the track. The yields are just not matching up very well. In saying all that, vacancy rates in Brisbane are improving. The official vacancy rate, just for your interest, was in 2021, and the fringe was 16%. That was the official rate. The unofficial rate was nearer to 50. We had the whole world was basically working from home, and there were subsidies going left, right and centre. So it was a really tough time for landlords. But we have really come a long way due to the factors a little bit before and that I mentioned in terms of high construction costs. Existing stock and take-up means that in the fringe now, we are now at a sub 10% category in places like Milton and Toowong, which is actually a really good story. I mean, anything under 10% is really quite good for office, but that has not translated really yet into face rents. The flight to quality that we've seen from 21 to about now has started to even out, and incentives have shrunk. But, we have not seen an increase, particularly in face rent yet. The graph here I really like the graph here on the bottom right. You'll see where the expected or the demand for both Brisbane, Sydney and Melbourne, all three there, the demand for office between now and 2033, I think it is, 2032, sorry, 2032, sorry. The demand for existing stock and office in Sydney and Melbourne stock is meeting the demand in that model. As you can see here on the left, Brisbane, we are far below that model, which means that we see, and if we're looking for opportunities today in terms of buying, as a buyer in the crowd today, I'd be really looking at freehold office buildings, even strata office buildings in the right areas near train stations such as Toowong or Milton, because as you can see, there's going to be a massive projected shortage of stock and increased demand. So we're going to see those face rents automatically rise because, tenants are going to have to pay to be where they are and to stay where they are. We've got to work out a way of being able to fill that stock gap. So that's an interesting dilemma that we face. Brisbane City Council have spent a bit of time in a think tank recently, and we're talking about near city development. So the Brisbane CBD footprint's quite small, and therefore the way we see CBD in the future is going to change for Brisbane. I mean, it's going to push into near city areas. So places like Milton and Toowong are going to get a lot more height. Fortitude Valley, Newstead, going to get a lot more height. So we're going to see sort of almost like an exclamation mark running up the Brisbane River because of the constraints we have on our CBD footprint. It's exciting news for investors and developers as long as we can get our cost base into gear in the next little while.
I'll just speak a little bit about the retail investment market that we're in at the moment. So Jeremy touched a bit on the office. So it's really been a dream story for the retail market. Anybody who owns retail or sold retail or is looking for retail, that's very competitive out there. Part of it, the buyer's agents are very much pushing that. As Jeremy said, it's very relatable. If you own a residential property and you want to get into commercial, retail is just much more palatable. Everybody's been in a retail shop, so they feel comfortable. So there's, we see it on boots on the ground. Whenever we put something for sale that's retail, there's a huge amount of demand, and it's pushing those yields really tightly. So, some previous campaigns, there was 80, 90, 100 inquiries, serious people looking at it. People are fighting for it. So the dream run is continuing. And even though, we speak about this, the CBD really hurt during COVID because there wasn't the foot traffic and the offices were all empty. CBD really hurt, and that flowed on a little bit into the fringe and the outer suburbs. But that's really rebounded. People are back now in the CBD. Retail businesses are coming back. They're trading well. Face rents are going back up. Incentives are compressing. So, retail's looking pretty good. I know cost of living's going up, but given the demand that we've got, I just don't see it going backwards in the next few years. So it's been a really, really good run. And then with the retail leasing, which underpins the retail investments, if you've got low vacancy and there's good demand in leasing, your asset stays strong. So for us, we also do leasing. Whenever it comes to retail leasing, again, there's a good demand. Jeremy does a lot here on the West. If you've got an office for lease or retail for lease, the retail will always lease first right now in this market. So there's still good demand, and the incentives are not too bad. They are definitely higher for foodie businesses, hospitality. They have a higher cost of entry, fit out, kitchen, lots of equipment, and they have a slower, break-even point. They need to drive traffic to their business and get the business up and running. So they do demand higher incentives. Just got to be careful with foodies. The ones that are not experienced can, they can fail. The big names, again, not all of them survive, especially the franchise model. You got to check the background of the operator behind it. In terms of rental growth, everything was going up last year, especially in Q4. And again, it's just there's not much new supply. Everybody's relying on the current supply right now for retail. In terms of the convenience center, I spoke about it. Everybody wants a little convenience center. It's even better if you've got an anchor, but then you probably need to get to 20 million to get a Woolies or a Coles anchored shopping center with 15 specialties. So not everybody can get there. So if you're looking at sub 10 mil, sub 5 mil, there's a lot more competition. You'll see those yields being compressed. But you can see this graph here. You've got super prime, regional, sub-regional. I wouldn't pay too much attention to that because unless you're a fund and you've got 50, 100 mil to spend, that's where that is, and there's not a lot of transactions. We got to look more at the neighborhood centers, and they're sitting around the mid 5% on average. That's a lot of your, Coles anchored, Woolies anchored, even sometimes, IG anchored or non-anchored. That's about the average. But as Jeremy said, we are seeing a lot of yield compression drive into the, even sub fives, especially if it's a good drive-through tenant, national 10-year lease, those can go for sub 5%. So yeah, we're probably unlikely to see a huge uptick in yields. Traditionally, interest rates go up, yields follow. We've just had the interest rate go up. Is it going to go up? I just don't see the yields following that closely the interest rate because the demand's too strong. So I think it's going to remain pretty tight for a little while. And just speaking about a case study, so this is a recent one. I personally sold in October, just here in the West, so it's a bit relevant, over in Kenmore. Convenience center, non-anchored. It's an interesting one because it's actually strata titled, that one interestingly, but there's 6 lots, 6 tenants, all owned by the one owner. So it's almost considered freehold really because they've dismantled the buddy corporate. But so treat it as a freehold, and it's an older asset, has short WALE, probably around 3 years. It should not have got 5%, but it did. So it just shows again, just the demand is driving the price. So for that asset, I would have thought it would have been a little bit, probably closer to the mid 5s, but I ended up selling it to the next door neighbor who had an interested, a greater interest, I guess you could say, in the land, and was willing to pay even higher than the closest bidder. So in the West, especially in the West, in Brisbane, we have the lowest supply of really anything, especially the inner West, retail office compared to the South or the North. So that even drives, tighter yield and even more demand.
Thanks, Phil. So another example of a good retail result recently was this. This is the corner of Baroona Road and Milton Road, right next to the new Coles Local. So this particular property is pretty tight looking property, to be honest with you. It was an overseas vendor who we acted on. We managed this property for about 15 years and still manage it actually now, happily with the new owner. This is a a bit of a rare one because we had two lots. The convenience centre was at the front at 16 Baruna Road. That was sitting on about 800 square metres of land. And then behind it, we had 271 Milton Road, which is basically a parking lot, which provided a great amenity for this asset at the front. So having 271 as an additional block really assisted the price on this because it was a good land holding. The buyer was very interested in the large land holding of this particular location. It's only 300 metres from Suncorp Stadium. The other reason we got such a great yield at this, and frankly, I haven't seen a yield tighter than this in Queensland in the last 18 months, is that the Coles Local was in construction at the time when we went to market, and that was very deliberate because there was a lot of buzz around that centre being repositioned and what that traffic could bring to a neighbouring centre. So we left the WALE really quite low on this and sort of, as opposed to a traditional residential model, you try to get your WALE up to kind of long-term safe investment, the rest of it. We kept the WALE actually on purpose low to allow the new owner to do rent revisions as those leases came up after the new Coles opened. So there was a real sort of strategy around the timing for this one, and it worked out really well for the vendor. And the buyer has since gone on and purchased next door as well. So he just purchased off market through me 2 Baruna Road, which means he's locked up the whole corner now, and he's sitting on about 3,500 square metres of land right there. So, and it's also dry land. So it's a really good key asset for this particular new buyer in the future. So we're moving on now to vacant possession office sales. So I touched on it before. The range is basically about 4,200 square metres through to about 6,500 square metres. A lot of factors go into that. 4,200 square metres, you're probably dealing with more flood affected stock or tired looking strata in not so great positions. So when I say not so great, further away from amenity, further away from transport links and so on. And then we go up on the high side at the moment to vacant possession rates of about $6,500 a square metre on building area. And there's a couple of examples I'll jump into right now. So the first one being 44 Benz Street, Toowong. So it was a first floor level strata. It's a whole floor strata as well. It means nice privacy for the owner. It's also serviced by an elevator, which allows us to then open up to medical users, for example, as a buyer pool. And it has 5 car parks, which for Toowong is quite generous. Toowong is pretty tight on parking, and to find a fairly good ratio. I mean, I consider a good parking ratio in Toowong about 1 to 50. So this was actually quite a strong sale. I also had 2 bidders on this, respectively, or 2 buyers, which helped also underpin the price. So that is what I would call classic kind of Toowong, well located but older looking stock. This particular buyer is going to have to come in there. They're going to have to refurb the whole place. It's a bit tired, but they've got a position there for the future, and the city plan and the future for Toowong is looking really bright in terms of uplift. So even though they may have paid a little bit more for that, they'll make that back in a year or 2. The next one here is 1 Mainview Street, Milton. This is a good example of something on the higher range of things. So this is about 150 metres away from Suncorp Stadium on the corner of Hague Road and Mainview. It is a good land holding. It's dry and it's got great parking. So, Brisbane is still in love with its parking. We are not a public transport city, and I don't see that happening anytime soon. So when you are looking for property, there are some buyers in this group. Please also, really consider when you're looking at a property, your parking options, because tenants will require it, and if you put your own business into there, your own staff will require it. So there's a couple of examples there.
Just again, if there's buyers in the group, just to mention a couple of opportunities. Jeremy mentioned it before, but office, I know it's been really off everybody's radar for the last few years. Nobody wants to touch it, but it's the Warren Buffett, model, just go the opposite direction everybody's going, and it's starting to turn. So people are starting to pick it up now. There's already big transactions happening. Our clients are buying at 8, 9, I've seen one at 10% just recently in Milton. Fair enough, you needed $80 million to make it happen, but they're taking the risk that they're buying at 8, 9, 10% and probably going to be able to sell it 6, 7, 7.5% in a few years. So I think if you're taking a bit of risk, and you've got to look under the sheets to make sure what incentives are being paid, because there's huge incentives, 30, 40, even 50%, I heard, at the top of COVID. So you really got to look at it. But if you buy right, and that's what you got to do in real estate, right? You got to buy right to buy low to sell high. Right now, office, on the property market, we're past 6 o'clock. So I think there is some opportunity if you've got the guts to get into it. I think it's, as Jeremy said, the supply, we're going to have, 1.9 million square meters short expected by 2032 in office in Brisbane. That's a huge number. So construction prices really got to relax, and we've got a lot of new stock to come up to meet that. But that's going to tighten yields, it's going to increase rents, it's going to tighten vacancies. So good opportunities there. And then retail, even though yields are tight, everybody wants it, I don't see it going backwards. But if you're going to buy it, it's location, location, location. There's still great uptick in rentals in Brisbane for retail. I think there was a price reversion or correction a few years ago. I don't think it's come back to it. I think there's still good uptick in retail rent. So even though you are buying in the 5%, it seems really tough because you're below bank rates now. What are you getting at the bank? They're probably lending to you at 6.5%. I'm not sure, and I know it's tough because might not be cash positive, but if you've got some lease expiries, some market reviews coming up, I think there's going to be some good growth happening there. So yeah, that's the opportunity. And then onto divesting planning. This is what we do on a day-to-day. So just a couple of pitfalls and a couple of tips to look at really. First thing is, when you're looking to divest, having a little bit of time, obviously, before you divest, as opposed to saying, I want to sell tomorrow, because the idea is you want to be a little bit of time to prepare the property for the highest and best use and figure out who's your buyer, who's looking at the moment. So to position that, you need a bit of time. So it's talking early with the agent. Then choosing the right timing, as Jeremy said, if you've got an office property right now with a 2-year lease attached to it, you're not going to sell it as a lease investment. I'm sorry, we just can't sell it. It's just nobody's touching it. So again, what's the advice on that? Okay, well, maybe you wait for vacant possession, or maybe you wait for the market to turn. So it's all about timing. Retail right now, it's hot. It's so hot. So if you get a retail one, you think of selling, you're going to get a great result. Next one is your lease position and your capex. So obviously, Jeremy had a good example about, usually you want a longer term, a better tenant. You want your WALE to go through. So you want to be able to do that before going market, or sometimes it's capital improvements, and sometimes it's just the tenant mix that's in there. So the tobacconist is very topical at the moment. It's all over the newspapers, but here on the ground, we were managing, I think it was about 7 in our portfolio. And it has been a really contrasting thing. The tobacconists, a few years ago, they started coming in, and it was almost a dream for the landlords. They were offering, top rent, above asking rents, no incentives. It was too good to be true. And yeah, it was too good to be true. Now we're dealing with the nightmare of having to kick them out, trying to sell a property with tobacconists. It's very hard because the new buyer can't get insurance. I think there's only 2 or 3 insurers out there that will touch it. So if you're looking to take your property to a tobacconist in it, don't do it. Prepare, get them out. And now with the new legislation, there's a mechanism to get them out scot-free for a landlord. So if you want to pick my brain on that, we've gone through 7 of those recently and exited them out legally. Choose the right method of sale. So, is it EOI? Is it auction? Is it private treaty? Is it off market, on market? That does make a difference. There are sometimes reasons for doing off market. You don't want to bother the tenants. You want to do it discreetly. You don't want to bruise the property. There are reasons, but in our experience, and we sell a lot of property each year, on market always wins because you create competition. So, but there are reasons for sometimes going off market. And choosing the right campaign also makes a difference, because there's some things you can't sell under auction conditions. And then marketing the property, look, we see it, there's a direct correlation between the investment marketing and the result. 1, in time spent on market, and 2, the price. We do it day in, day out. So if you're going to go big, scream it loud, create the most competition. It's a simple formula. That's it for us. So that's FAL's bit, and we'll pass it on to Sam, the CEO of Outkast, for the next section onto construction costs.
Great market at the moment, isn't it, for a lot of people, and appreciate the opportunity to talk about construction costs and how we can be smart and strategizing to make sure we get the most efficient out. A little bit about Outkast. We're a design and construct business. We've been on operation for over 16 years. We're headquartered up here in Brisbane. We do work across the eastern seaboard. We have in-house capability from consultancy, interior design, project management through to construction delivery. We are all under one roof. Creating and capturing value for our clients is one of our ethoses that we look to, I guess, execute every day and in every deal, and service is the way we do that. So always happy to talk a little bit more about Outkast when the time permits for those people out there. Agenda, so going to focus on sort of strategic cost controls in 2026. What can we be doing to manage that? Some pitfalls to avoid in doing your fit outs, and asset repositioning, as Jeremy and Phil sort of touched on, as a good opportunity in the market today. And then just a few takeaways. So strategic cost control in 2026. So Queensland has entered a sustained construction super cycle. I think Jeremy said it best, it's on the news every evening. Labour shortages, workforce capacity. We are seeing that translate directly into our day-to-day activity at the moment. Procurement of consultants and subcontractors is becoming increasingly challenging. Time delays in getting quotation back. Job selection. Subcontractors are starting to choose jobs that they want to work for. All the sort of fiddly stuff, not the high value stuff they're not really interested in. So we've been working quite proactively at Outkast to make sure we have the right procurement chain, because ultimately we need to deliver in a timely fashion and cost effectively. But again, I guess it's calling for a little bit of guerrilla warfare, I guess, in the way we sort of procure our projects. With that in mind, obviously significant price variability. So you're getting wide cost ranges, reduced pricing and program certainty is becoming a bit more challenging. So that's sort of a general view. I thought we'd have a look at how cost is determined. So I guess construction, commercial fit out costs are the outcome of sort of time, quality and scope interacting together. Obviously quality, setting the product target, is directly correlated with your cost. The biggest impacts there, and making sure we minimise the cost, is going to be around your scope detailing and the time you allow. So again, strategically planning ahead of time, allowing time to make sure we detail scope accurately, we can go to market, contractor procurement's done properly, you widen your range for procurement of products, contractors, etc., and that ultimately reducing or put a downward pressure on your costs. So I guess predictable costs are achieved by balancing all three, not just optimizing one of those. So when we look at strategic cost control, obviously, as I sort of stated before, planning, overcoming time pressure, setting that strategy, having a clear defined strategy, scope clarity, coupled with a construction-focused design discipline. It takes me back to my university days in the Bauhaus School of Design over in Germany, where form follows function, or minimalist approach was sort of at the key of their design principles. And it's something that in our business we constantly work on. Form follows function, so functional focus, operational focus, and allowing the form to sort of take shape as a result of that. We're not aesthetically led, what pretty stuff do we want to see. We are really focused on the operations, and you tend to get the most efficient outcomes when you look at it from that perspective. Procurement timing, again, I mentioned it before, but longer allowances, you're creating larger contractor pools, product options. Value engineering, we use that word all the time. In the right process, it's testing value versus cost. It's a scenario of what we must have and what we need to have. And if you give yourself the right time, you're going to, again, get the right outcome. And it tends to come back to, again, that functionality brief. Operationally, what are we looking to achieve? And is it actually worth spending that extra money? Adaptive reuse and standardization. So the gents touched on it before. Greenfield sites at the moment are increasingly challenging to make stack up. So we're working with a lot of clients in asset repositioning, and we'll touch on that a little bit later in the presentation. But not just from a building perspective, but from a detail fit out perspective, retail perspective. There's a lot more reuse. We're dealing with a lot of landlords where, if you're in retail shops, trying to reuse grease traps, mechanical services, etc., and designing for those services that are already in there. Same with a lot of the infrastructure in commercial buildings. When we're designing, looking at supplementary air, fresh air intakes, all these sort of services that are heavy costs that no one likes to sort of see in any sort of fit out or costs when you present it to them, but they're important. So how can we reuse those? How can we get amortization over a certain 2 or 3 lease term period with those costs? So, and again, life cycle considerations. So cheap isn't always best. Again, it's planning ahead, and it is more around that base building infrastructure, the services that you guys would need to consider. Risk identification and contingency control. Again, a big philosophy for us is just don't ignore the potential risk outcomes. They're there, they're involved in every process. It's a key to identify them, try to put a cost around them, and how you can mitigate them. I think if you get involved in processes where you choose to ignore risk or only look at the green light, you're going to get caught out. I think, again, that's something that as a business we do very well with our clients. So again, it's just identifying those. And delivery process is probably Again, in my personal view, one of the key ways to strategically manage cost control, we sort of look at the traditional methodology versus the design and construct. And a lot of people will be hearing this early contractor engagement or early contractor involvement, ECI, ECE processes. And if I go to the next slide, so your traditional method, as the majority of us will all understand, you have your owner. The owner might be the pseudo project manager or engage with the project manager. They're going to go out to market, seek an architect. The architect might be the lead consultant managing your consultants, or you might go to the consultants directly. They then prepare your full documentation based off your initial brief requirements, etc., aspirations or your client needs. Then you go to tender. And at that tender time, now you're starting to understand some pricing. So you've spent that time, and typically as a business, we do get involved in the traditional methodology as well as design and construct. But that tender time, the builder, we're always asked value managed solutions, other options, and then we find a lot of time is just spent going back to the architects, service consultants to up that documentation to really try and drive those costs down. Personally, not the smartest way to sort of set out to handle that situation, but that's where the market I've seen increasingly over the last 24 months coming up with this whole early contractor engagement. Let's get that contractor up front, making sure they're inputting some value into the architectural process, so we're trying to shortcut the rework after we go to tender. Obviously, a design and construct method, the owner will go out and you'd engage with an integrated design and construction team, such as Outkast. And in parallel, design cost and buildability is managed from the outset. So typically, a lot of our clients come to us, usually dollar focused. I've got this much, what can we achieve here? Or the deal needs to stack up at this incentive level. This is what we've got. So it's always reverse engineering. I guess one thing on this, I think people from the traditional method camp, so to speak, will say that you get better design outcomes with the architects and consultants when you focus purely on design. I tend to disagree. I think it's just a bit of smoke and mirrors. We like to feel good about getting a great design, but if you can't make the deal stack up, what's the point? We, however, on that design and construct methodology, we do lead with the cost. We've got our finger on the pulse the whole step of the way. We know what the costs are going to be. We're presenting solutions that are going to work to your budget immediately. Again, time, cost, it's just the focus of that delivery methodology. And I guess this graph here probably just explains it a little bit clearer. So cost certainty under design and construct, it's early, traditional, it's late. Risk, it's managed up front from a D&C perspective. Your risk is repriced at tender. Variations, again, with a single point of contact, it's reduced. Whereas in the traditional methodology, they're common. We do win a lot of jobs under that traditional methodology, and increasingly as a business, it's a bit more challenging because we have to literally manage variations. What were the nuances in the documentation? Did we allow for, etc. And there's always ambiguity, and there's multiple people in that process, and it can become a bit of a finger-pointing show, etc. So that sort of, I guess the market volatility, etc., and the risk is quite exposed. Obviously, the program for design and construct, it's overlapping. You'll save 15 to 20% on project timelines going through a D&C model. As it sort of says down there, design and construct, lower owner risk, early cost certainty, and then traditional delivery is higher owner risk, cost and buildability known later. All right, fit out pitfalls to avoid. So again, just translating that, there's obviously a common theme with all of these, but timing, it never ceases to amaze me where we get engaged with clients that have signed leases with really little disregard for what it's going to cost or program it's going to take. Straight away, if we go back to that cost triangle matrix, they've just stumped themselves on time. We're working, I guess, very hard to get them an outcome. Their costs are going to go up. Inevitably, just planning is going to solve those problems. Poor or unclear scope definition, particular here, again, cost differentiation between landlord works and tenant works. Again, base building infrastructure services, versus tenant services, how they're going to be captured. Every landlord has got a different strategy to this. Again, and the next slide will sort of talk more about how we sort of handle it, but it's just that early engagement, that discussion and setting those parameters can really save cost and time. Relying on rate per square metre benchmarks, it's another favourite of mine. Constantly asked how much does it cost per square metre for a fit out. If you're talking 100 square metres, it's $2,000 a square metre. What's that including? Has it got AV? Has it got data? Is it including the flooring? Was the ceiling already in there? Is there lights? Is it 1,000 square metres? And again, I could express it as $2,000 a square metre. Each of those offices have got a kitchen, they've got a boardroom, they're going to have those particular services that are fixed costs. The larger, usually the rate per square metre is reduced just because of the quantity of workstations. But again, it's just so specific to the deal, and it's important to accept that. I think if you're doing feasibilities or you're looking at scenarios and you're just using rates per square metre, there's just real smart ways to drive that down. Every instance I guess, is quite particular to that deal. We'll always say to a client, we not really want to give you a rate per square metre. Let us actually just do the work, do the price, and give you the price for that location. Late design changes, obviously, it goes without saying, really. If you change your mind late in the piece, it's going to add cost. Using that traditional design, tend to build in a tight subcontractor market, I think it kills deal momentum. Again, we sort of experience that ourselves. You go to tenders, as we did recently at 100 Wickham Street for Capital Land. There was 5 of us tendering for it. They had a designer, a project manager. They came out, I think, in end of January. They wanted to be started first week of March. I think we're literally one of 2 at the moment, but they're just going back and forth because the budget didn't hit where it is. They're now talking with the architects of what reduction they can do in the design. But again, it's just stalling the process. And it's very hard to maintain those sort of costs, because in today's market, when you're looking at these sort of short-term projects, that procurement chain that I sort of spoke about before is just invaluable. So you've got to make sure when you're submitting your price, we're literally going to start in 2 or 3 weeks. We've got the subcontractors already there with their prices, and that deal momentum truly does give you that best price. There's no 2 ways about it. The moment we're sort of lacking, I guess, I say lacking that time urgency, all of a sudden we have to reprocure, our price becomes a little bit more unstable, our profits go down, it's more challenging for the subcontracting entities also. Value engineering, too late, or focus on downgrades instead of function. Again, it just becomes a cost-cutting exercise if you leave it too late. Ignoring logistics, access, and delivering sequence impacts. Again, minor things, but all part of it in terms of how do you deliver those works. Again, I just mentioned before, sort of the Outkast way, so client deal-centric. So what I mean by that is ultimately no construction exists unless the deals don't stack up. So in terms of the way we would approach things, and perhaps other D&C companies, it has to work for the deal. The deal matrix has to stack up, whether it be the incentive level, whether it be adaptive reuse of existing fit outs, whether it be timing, etc. We have to reverse engineer our deals. I mean, ultimately, that's where we're getting to. Everyone likes a nice fit out. We design great fit outs, but ultimately, everyone needs the deal to stack up. You need a place that's operational so you can function your business, and the landlord needs to have a sustainable tenant in there that's going to be paying the rent and I guess add value to their asset. How do we do this? A lot of the clients that we have relationships with, it is around that early engagement. It's understanding your asset, it's sharing that information with you from a fit out perspective as to what are some of the considerations from a cost perspective, whether it be infrastructure, again, going down that whole reuse target. We obviously use the design and construct delivery to integrate design, cost and construction under the one process. We can engage and do engage in these ECI structures, again, just providing input at the right time. Another key thing for us is obviously we're out there in the market every day, and we've got 10 to 15 jobs at any one time happening. We're constantly pricing, so subcontractor intelligence, movements in pricing just enables us to strategically put our clients in the right positions. Defining and freezing scope early. The best and most successful jobs are the jobs that are clear and concise from the outset, and we're clear and concise with that whole procurement chain. Changes along the way, they just add pain, delay and cost, and it's inevitable, unfortunately some of the times, but if you can just really focus on that scope and signing off up front, it's smooth sailing. Structured procurement to suit current trade appetite and capability. Again, obviously different tiers of subcontractors, different tiers of quality that we're trying to achieve, different price points. You've got the man and the ute, you've got the mid-tier companies, etc. So again, that comes around timing, cost constraints, understand the client's requirements, your asset type and class, and who we would look to put into that sort of delivery train, so to speak. Applying early functional value engineering, again, focus on outcomes, not downgrades. And ultimately, a single point of accountability from concept to completion. I think that's probably the biggest key is when you're dealing with a design and construct company, typically you're dealing with the one person all the way from the beginning, your aspirations, your targets, the deal matrix, all the way through the delivery and achieving that result for you and handing the keys over to your tenant or to yourselves in capital upgrade works. Asset repositioning, so some low cost, high value upgrades. So again, obviously the objectives is to reduce vacancy, improve leasing velocity, increase tenant appeal through experience and amenity, stronger rental uplift and strong lease terms, de-risk for refinance, valuation events with the clearest story, so a CapEx pathway, and then deliver improvement without major disruptions and heavy CapEx. So it's got this graph sort of showing some key items on what we would look at, and we're doing this pretty much on a daily basis with a lot of our clients and their assets. High value, low cost, pretty simple. It's all about the inspection experience. I think that's, and I guess the gents would probably speak more to this, but going out that inspection experience, does the client or does the vendor care about their asset? Have they got a clean lobby, fresh? Have they got wayfinding signage, LED lighting? Lighting remarkably really cost effective, but makes a massive difference. End of trip cosmetic upgrades. We go into a lot of older buildings. Yeah, we have a bathroom, a shower down here, but when you look at it, you'd never actually use it. So making sure that they're fresh, they're clean, they speak to, I guess, the pride that you would have in owning assets, and then that in turn is going to be able to, I guess, attain or seek and get your tenants. Medium value to low cost, so building paint, presentation uplift. It's amazing what paint in a building will do. That just really repositions it. Branding, graphics, landscape. Again, just a lot of pride in the asset. We sort of see that work quite well. Obviously, as a business owner myself, you want your staff to feel engaged with the place they're working at. They want to come and have a bit of pride about the location, the look, the feel good. You don't want them rocking up to something that looks dilapidated, old, I don't want to shower. Again, it's that motivation. Let the tenant focus on the internal fit out, but there's a lot that you can do to sort of help reposition that asset. That goes up to item number 3, high value, more medium cost. So it is lift lobby upgrades. Again, flooring solutions, lighting, just a little bit more of a robust solution to change that. Spec suite creation, again, not dissimilar to display homes, but just doing display suites that are, I guess, general in terms of their layout, but they definitely showcase the way the property can be presented, especially with a lot of older assets. To be able to do one particular fit out in an area can actually just visualize that for your incoming tenants and what they can achieve. Again, a lot of buildings we'll walk into have got old fit outs. They've been there for 10, 15 years. It's all dated, it's heavy, it's old, and for whatever reason, we lack the ability to visualize what it can be. And the best visualization is obviously with a speculative fit out. As a business, we also have, in terms of our interior design, we have visualizers, renders, 3Ds. We're seeing that become quite prevalent in the residential market. We're finding that also as a great tool to work with landlords to help market their properties. But again, that visualization, that I guess selling to the emotion effectively is quite critical, and you can do that through there. Tenancy resizing, obviously just creating some depth in the market so you can look at different tenants at different sizes and showing how you can split your tenancies there. And then obviously high cost, low value, I guess, full facade replacements. Again, probably more a necessity if there's issues with your facade as opposed to something you just want to go and do. Overspecting finishes or major paint replacements with a leasing trigger. A good example, we're working with a client that owns a retail asset in Adelaide Street. The mechanical's fairly shot. We're sort of priced the new mechanical to remove the old one, but he won't pull that trigger until we get 2 or 3 tenants that are on a longer sort of, I guess, fit out construction time, and we can sort of roll that in with that because it's going to be quite a heavy cost. So I guess the key targets, first impressions, drive leasing velocity, target upgrades that tenants feel first, lobby entries, lift lobbies, signage, end of trip and amenities. Again, fresh and clean, flexibility. So again, tenancy sizing, spec suites can shorten downtime of leasing initiatives. And ultimately, I guess repositioning is about focusing capital on perception. So it's a perception, it's a look and a feel. It doesn't need to be dollar heavy. It doesn't need to be rebuilding elements of your building. There's a lot of real sensible things you can do. And disciplined capital allocation, I guess protects your long-term asset value. So just lastly, just some takeaways. Obviously, cost certainty is decided early. Time, scope, clarity, delivery strategy have a much larger impact than the headline figures. Time, give yourself time, talk to the right people. Design and construct, obviously we're spruiking that because that's what we do, but I do strongly believe it's the most sensible approach. And obviously repositioning values come from customer experience, not heavy CapEx, and spend where occupants feel it first. So ultimately it's smarter decisions outperform bigger budgets in 2026.